What if surviving just one October day could have kept an entire global economy afloat? In 1929, a single moment, when margin calls forced investors to sell and bank runs left people empty-handed, ignited chaos so intense that it triggered one of the darkest economic periods in history. But here's the real question. How could everything, jobs, homes, even trust in banks, collapse from one domino falling, especially when there was no deposit insurance to protect people's savings? Stick around because you'll discover how a lack of safeguards and unchecked optimism set the stage for disaster. If you're interested in avoiding these pitfalls in your own portfolio, hit subscribe now. Let's look at how prosperity in the 1920s hid the warning signs that would soon bring everything crashing down. During the 1920s, the United States experienced a surge of optimism that seemed to touch every part of daily life. The Roaring Twenties brought a wave of new inventions and mass production, making products like cars, radios, and household appliances widely available. Henry Ford's Model T, for example, became affordable to millions thanks to assembly line production, but what really fueled this consumer revolution was the ability to buy now and pay later. Easy credit became the engine behind the boom, with banks offering loans and installment plans that allowed families to fill their homes with modern conveniences regardless of whether they had the cash on hand. This shift in consumer culture wasn't just about convenience. It was about confidence. People believed the good times would keep rolling, and banks were eager to lend. By 1929, 40% of all consumer debt was tied to the stock market, a statistic that reveals just how intertwined everyday life and financial speculation had become. The appetite for new goods pushed manufacturers to ramp up production, and as long as consumers kept spending, it seemed the cycle could never break. But the foundation of this prosperity was increasingly built on borrowed money. Few paused to consider what might happen if that confidence wavered. The fever for growth extended far beyond household spending. The stock market became the center of national attention, drawing in people from all walks of life. Between 1921 and 1929, the market's value multiplied 6 times over. Investing was no longer the exclusive domain of wealthy financiers. Factory workers, farmers, and even barbers joined the rush, convinced that stocks would only move upward. The method that made this possible was buying on margin. Investors only needed to put down 10% of a stock's price, borrowing the rest from brokers. This meant someone could control $1,000 worth of stock with just $100 of their own money. The promise of huge returns was intoxicating, but the risk was equally large. If stock prices dropped, investors would face margin calls and be forced to repay loans they couldn't afford. While stock prices soared, the real economy didn't always keep up. Factories started to notice that demand was slowing. Many Americans had already bought the latest appliances and cars, so the need for more began to fade. Despite this, the stock market kept climbing, driven by hype and speculation rather than real profits. The disconnect between market values and company earnings created a fragile system, increasingly vulnerable to stocks. The sense of invincibility made it easy to ignore warning signs, but the cracks were there, masked by a culture that believed in endless progress. Banks played an active role in stoking the flames. They didn't just finance consumer purchases, they also loaned heavily to investors eager to buy stocks on margin. Risky lending wasn't just accepted, it was encouraged. With no federal oversight or deposit insurance, banks operated with few constraints, making the entire financial system much more exposed. As long as asset prices kept climbing, everyone, from bankers to small investors, felt safe. The reality was that the whole structure depended on continued optimism and the ability to borrow easily. Internationally, the picture was less rosy than it seemed. After World War I, Europe struggled to recover, and global trade lagged behind its pre-war highs. The U.S. economy, while strong domestically, couldn't rely on exports to maintain its momentum. These global pressures added to the underlying weakness, but most Americans focused only on the prosperity they saw around them. By the late 1920s, the illusion of unstoppable prosperity was nearly complete. Borrowed money propped up both consumer spending and stock prices, and the belief that nothing could go wrong was widespread. But when so much depends on confidence, even a small shock can send ripples through the entire system. The stage was set for a sudden reversal, one that would test just how strong that faith in endless growth really was. When panic replaces optimism on Wall Street, everything changes in an instant. On October 24, 1929, Black Thursday, the atmosphere in the New York Stock Exchange shifted from routine to chaos. The market opened with a sense of unease, and as prices began to slip, anxiety quickly escalated. Within hours, investors rushed to sell, triggering a record 12.9 million frantic trades in a single day. The market plunged by 11%, and the sound of ticker tape machines struggling to keep up became the soundtrack of a crisis. What had felt like a stable, ever-rising market now looked dangerously fragile. The speed of the collapse was fueled by the widespread use of margin buying. By 1929, 40% of all consumer debt was tied to the stock market. Investors, having bought stocks with only a fraction of their own money, suddenly faced margin calls, demands to repay loans immediately. With falling prices, they had no choice but to sell at any price, creating a cascade of forced sales that accelerated the crash. The urgency was unmistakable. Loans were due immediately, forcing fire sales. This mechanism didn't just impact wealthy speculators. Small investors who had believed they were building a future watched their savings evaporate and found themselves in debt they could never repay. The emotional shock was profound. News of the crash spread far beyond Wall Street, reaching factory floors where workers paused to listen to radio updates, and families gathered around kitchen tables, worried about what tomorrow would bring. Confidence in the market, once seen as unbreakable, fractured in a matter of hours. For many, the realization set in that fortunes could disappear overnight. The sense of security that had defined the previous decade was suddenly gone. Just days later, on October 29, Black Tuesday, the situation grew even more dire. This time, the panic was even greater. Over 16 million shares changed hands, and the market tumbled another 12%. In just 2 weeks, the stock market had lost a third of its value. The numbers are staggering, but the human impact was even greater. Life savings vanished. Fortunes built over decades were wiped out in hours. The losses weren't confined to investors. Businesses, banks, and ordinary families all felt the shock. Banks that had extended risky loans to investors now faced losses they could not recover. As their balance sheets deteriorated, they pulled back on lending, cutting off credit to businesses and consumers. The financial system, built on trust and the expectation that tomorrow would be better than today, started to falter. For everyday people, the crash was no longer just a headline. It became a struggle to hold on to jobs, keep homes, and protect what little was left. More than just a financial disaster, the crash marked a turning point in the nation's psyche. The belief in endless growth and the reliability of financial institutions evaporated. People questioned whether their banks were safe, whether their jobs would last, and whether the future they had planned was still possible. Economic trust, once taken for granted, was now in short supply. Without it, the gears of the economy began to grind to a halt, spreading the crisis from Wall Street into every corner of American life. But this was only the beginning. The collapse of trust in the markets quickly spilled over into the banking system itself, setting off a chain reaction that would test the stability of every institution people relied on. The next domino was about to fall, and it would hit even closer to home. As the panic on Wall Street faded from headlines, fear began to grip the banking system. The stock market crash had shattered confidence, and people started to question whether their money was safe in the very institutions meant to protect them. Without the safety net of deposit insurance, a single rumor or unsettling headline could send crowds flooding to their local banks, desperate to withdraw their savings before it was too late. These scenes played out across the country, turning uncertainty into a nationwide wave of bank runs. Imagine lines of anxious depositors stretching down city blocks, each person hoping to reach the teller before the vaults ran dry. Banks, which operated by lending out most of the money they had, simply didn't have enough cash on hand to meet these sudden demands. Even healthy banks could be dragged under if enough customers showed up at once. In New York City, for example, a rumor that the Bank of the United States had refused to sell someone's stock led to a massive run. By the end of that day, $3 million in deposits had been withdrawn. The bank collapsed soon after, and its failure only deepened the public's fear. The scale of the banking crisis was staggering. By 1933, over 9,000 banks had failed, wiping out $550 million in deposits. For many families, this meant the loss of a lifetime savings overnight. The impact wasn't limited to those who lost their money. Trust in banks evaporated, and people stopped depositing their paychecks. With fewer deposits, banks had even less cash to lend, making it nearly impossible for businesses to secure loans or for families to finance essentials. This breakdown in the banking system quickly choked off the flow of credit, which is essential for a healthy economy. Businesses couldn't borrow to buy inventory or pay workers. Farmers struggled to buy seeds or equipment for the next planting season. As banks hoarded their remaining cash, the entire system locked up. The result was a sharp decline in economic activity, with businesses forced to cut back or close entirely. Layoffs became common, and unemployment began to surge. At the same time, another problem was taking hold: deflation. As the money supply shrank, falling by 31% between 1929 and 1933, prices and wages dropped across the board. On the surface, lower prices might sound like a good thing, but for anyone with debts, it was a disaster. Debts didn't shrink along with prices, so while people earned less, what they owed stayed the same, making it harder and harder to pay back loans or mortgages. This vicious cycle discouraged spending, froze investments, and pushed more businesses into bankruptcy, deepening the crisis. The Federal Reserve, which could have acted to ease the crisis, failed to respond quickly or forcefully enough. Instead of cutting interest rates and increasing the money supply to restore confidence and liquidity, the Fed allowed the contraction to continue. Most historians agree this was one of the greatest policy failures in U.S. history. By the time officials recognized the scale of the disaster, the damage was already done. The effects of these failures rippled through every part of American life. As banks collapsed and credit dried up, industrial production plummeted and unemployment soared. By 1933, nearly 25% of the workforce was out of a job. Business owners faced impossible choices: lay off workers or shut down entirely. Farmers watched crop prices collapse while their debts remained fixed, driving many off their land. Even those who managed to keep their jobs weren't immune, as shrinking demand meant businesses struggled to survive. The human toll was immense. The loss of savings erased retirements, destroyed the hopes of families, and left millions in poverty. For many, the psychological blow of losing everything was as devastating as the financial loss. Trust in the banking system and economic leadership was shattered, and the sense of security that had defined the previous decade was gone. But the consequences didn't stop at America's borders. The unraveling of the U.S. financial system sent shockwaves around the world, setting the stage for a crisis that would soon engulf the global economy. As the crisis deepened at home, the consequences of economic collapse quickly became visible in every corner of daily life. The Great Depression didn't just devastate Wall Street or the banking sector, It reached into homes, farms, and factories, reshaping the lives of millions. One of the first government responses, the Smoot-Hawley Tariff Act of 1930, was meant to shield American industries by raising taxes on foreign imports. Instead, it triggered a wave of retaliatory tariffs from other countries, and global trade plummeted by more than two-thirds between 1929 and 1934. Nations that depended on exports found themselves suddenly isolated. Raw materials, food, and manufactured goods stopped moving across borders, deepening the downturn for everyone. While international trade ground to a halt, another disaster unfolded across the American Midwest. Years of aggressive farming had left the soil exhausted and fragile. When drought struck in the early 1930s, the land simply gave way. Winds picked up the dry earth, creating massive dust storms that swept across the Great Plains. Farms were buried, crops failed, and livestock starved. For tens of thousands of families, the land that once promised opportunity now offered only hardship. The Dust Bowl forced many to leave their homes behind, joining a wave of migrants heading west in search of work and survival. Their journey was rarely met with open arms. Jobs were scarce, wages were low, and the promise of a better life was often out of reach. The economic toll was staggering. By 1933, unemployment peaked at 25%. More than 34 million Americans found themselves without income, and many lost their homes. Cities and towns saw the rise of Hoovervilles, makeshift communities of shacks and tents built from whatever materials people could find. Bread lines stretched around blocks, and soup kitchens became a daily reality for families who had never imagined needing charity. The loss of stability was everywhere. Skilled workers stood idle, children went hungry, and entire communities struggled to hold on. For those who had built their lives on the promise of steady work and secure savings, the Great Depression was a personal catastrophe. Imagine being a farmer who once took pride in a thriving field, now forced to abandon everything and travel hundreds of miles for a chance at a day's work. Or a factory worker laid off with no warning, watching savings evaporate and facing the uncertainty of where the next meal would come from. The suffering was not limited by geography or background. It was a shared experience that cut across the country. The crisis also exposed how fragile and interconnected the world's financial systems were. International banks failed, currencies destabilized, and the lack of coordination between nations made recovery even harder. Countries turned inward, prioritizing their own survival over cooperation. The collapse of global trade and finance revealed just how quickly confidence could unravel when trust and regulation were missing from the equation. In response, the United States began to rethink the structures that had allowed such a disaster to occur. President Franklin D. Roosevelt's New Deal signaled a new approach. Federal deposit insurance was introduced in 1933 with the creation of the FDIC, restoring confidence that money in banks would be safe. The Securities and Exchange Commission, SEC, established in 1934, brought oversight to Wall Street and aimed to prevent the reckless speculation that had fueled the crash. These reforms didn't erase the pain overnight, but they laid the groundwork for rebuilding trust and stability in the years ahead. Understanding how a national crisis became a global catastrophe and the immense human cost that followed underscores why strong financial systems and informed decision-making matter. Protecting your own wealth means recognizing the warning signs of systemic risk and staying vigilant about the health of the systems you rely on. As we look back on this era, it's clear that the Great Depression left more than economic scars. It challenged the very foundation of trust in institutions and forced a re-examination of how financial systems should work. In the next section, we'll explore how trust, once lost, can be rebuilt, and what lessons from the past still matter for our financial future. The Great Depression exposed just how vulnerable financial systems become without strong oversight. Practices like unchecked bank lending and buying on margin magnified the fallout, while the Federal Reserve's slow response allocated the crisis to deepen. These events proved that robust regulation is the most effective safeguard against economic disaster. Financial literacy and clear rules aren't just helpful, they're essential for protecting your future. What safeguards will you put in place to avoid the next crash? If you found this valuable, like and subscribe for more insights on building a resilient portfolio.